Hi, I'm Renee Glendenning, a shareholder at Barbario & Company. I'm here to tell you about foreign nationals and the Foreign Investment in Real Property Tax Act, known as FIRPTA. The IRS has many regulations regarding foreign nationals investing in the U.S. One of the more detailed and potentially confusing regulations concerns the sale of U.S. real estate by a foreign person. When a foreign person sells U.S. real estate, he or she is subject to having 15% of the gross sales price withheld. This 15% withholding must be remitted to the IRS no later than 20 days after the closing. However, there are exceptions to this general rule. The withholding is not required if the sales price is $300,000 or less and the buyer intends to use the property for personal purposes as a residence for at least 50% of the time it is in use for the next two 12-month periods following their purchase. In order for this exemption to apply, the buyer must be an individual as opposed to a partnership, corporation, trust, or estate. Let me give you an example. Say a foreign person sells U.S. real estate for $250,000. This is under the $300,000 limit I mentioned before. The buyer intends to rent out the property for 3 months of the year and use it personally for 4 months of the year. Even though the property will be vacant for the remaining 5 months of the year, the exclusion could still apply because they will use the property for 4 out of the 7 months it is in use, which is 50% or more. The buyer would have to state that this is his intention for 2 years following the purchase of the property by signing an affidavit to this effect. Otherwise, the seller would be subject to the 15% withholding requirement. If the sales price exceeds $300,000, no exemption from the withholding is available, regardless of the buyer's intended use of the property. This is the case whether the sale results in a profit or loss to the seller. There's one more option regarding the 15% withholding that should be considered. If the actual tax on the sale is significantly less than the 15% withholding, the seller may apply for what is known as a withholding certificate from the IRS. This certificate allows for an amount of less than 15% of the gross sales price to be withheld from the closing proceeds. Let me give you an example. A property is being sold for $500,000, but it was purchased for $600,000, so the seller will incur a significant loss on the sale, and ultimately no tax will be payable. The seller is still subject to a withholding of $75,000 on the sale. The seller may submit an application to the IRS stating that the sale will result in a loss and request that the withholding be reduced to zero. This application must be submitted to the IRS no later than the date of closing. Otherwise, the 15% will have to be sent to the IRS no later than 20 days after closing. The decision of whether or not to apply for a withholding certificate depends on the particular circumstances of the sale. Factors to consider include the amount of the actual tax compared to the amount of the withholding, the timing of the sale, and the income tax reporting deadlines. Depending on what time of the year the sale takes place, it may be preferable to forego the application. Every situation is unique, and the rules surrounding foreign nationals and FIRPTA can be confusing. If you have any questions about selling your U.S. property or any other international tax questions, Barbario is available to help.